Hi, I'm your host, Arthur Richier, Head of Strategic Partnerships at Vortexa, working alongside our global partners from our UAE headquarters and amplifying market intelligence for Vortexa's analytics. Today, I'm delighted to be joined by Xavier Tang, Market Analyst at Vortexa's Singapore office for the August edition of our MENA Energy Insights. Now, today we'll be focusing on OPEC-8 crude oil exports and see whether seaborne flows reflect the recent announcements to unwind production cuts. On the other hand, we'll take a look at US crude exports as well and how both OPEC and US supply cushions oil prices globally. Another widely discussed point in the markets as of now is Russian crude oil flows into India. Now, following EU sanctions over the Vadinar refinery specifically. And in July, we've seen Russian crude arrivals into India decrease by about 280,000 barrels a day. That is excluding Kazakh barrels, which was driven by a hesitance of Russian origin tankers to discharge in Vadinar. In this briefing, we're going to revisit whether these surplus volumes can be absorbed into other demand pockets and what that may mean for the tanker market in the Far East. With that, let's start. Now, Xavier, tell us a bit more about OPEC-8 and US crude exports.
Yep, thanks, Arthur. Now, despite the unwinding of production cuts, OPEC-8 crude exports have not really seen sizable increases in terms of export volumes. Now, at the same time, we have seen that US crude exports have actually hit multi-year lows, as shown in the right-hand side chart. So these two factors in combinations are actually currently supporting the oil prices right now. Now, starting from the left-hand side chart, we show the OPEC-8 crude and condensate exports on a seasonal basis with two target scenarios. Now, the first target scenarios assumes the adjustments in voluntary production cuts are reflected on a one-to-one basis in exports, while our second target scenario takes into account adjustments in seasonal export patterns. We have seen a slight increase in exports in June as more barrels were actually being pushed out during the Israel-Iran conflict. However, export volumes have not really increased on a month-on-month basis in July, reflecting that OPEC-8 members are not really pushing out as many supplies as the market had initially expected. Now, when we break down the OPEC-8 exports by countries, we also found that UAE is actually one of the key drivers in the increase in exports over the past 2 months. Another factor in terms of crude supply is the US seaborne crude and condensate exports. And in July, the volumes have actually fallen to multi-year lows of slightly above 3 million barrels per day. And the last time we saw such low export volumes was during the COVID period. Now, the key contributing factor for the decline in US exports is actually the increase in refinery runs in the US Gulf Coast, which has kept the barrels in the domestic market instead of it being pushed out for exports. Another reason is also the decline in arbitrage flows towards both the European as well as Asian countries, though the increase in flows towards Africa have slightly offset these declines. So in totality, these two factors have actually kept oil prices supported at the moment, alongside some of the recent sanctions, tariffs, as well as secondary tariffs that we have seen over the past few months.
Thank you, Xavier. Now, if we turn our gaze further east, what's going on with Chinese crude inventories onshore specifically?
Now, we have seen some interesting dynamics in Shandong onshore crude inventories, which have been on an upward trend since the mid-2022. Now, most of these increases in onshore crude inventories are actually contributed by the growth in commercial stocks, which have been rising in parallel with the total Shandong inventories. Now, over on the left-hand side chart, we can see that China's crude and condensate imports from Iran in 2025 were mostly higher than the 3-year historical range, implying the continued demand for these discounted barrels. Imports have actually rebounded above the year-to-date averages in August, as traders have rushed to move these barrels onshore amid the heightening US sanctions on Chinese facilities. Now, we have also seen that the Shandong refiners anticipated potential US sanctions on ports as well as terminals, and hence we have seen this acceleration of discharges from the floating cargoes, moving these barrels into the onshore storage. And this has also led to a sharp build-up in terms of Shandong's total onshore crude stocks. Now, on the right-hand side chart, despite we have seen the already elevated inventories as well as lagging refining consumption, this acceleration has actually lifted the Shandong crude stocks to a sixth consecutive monthly build, and total volumes have actually reached about 293 million barrels in commercial stocks as of the 24th of August, up by about 20 million barrels from early July volumes. So all in all, traders are expected to keep moving these floating barrels onshore ahead of the September's refining peak. But with Shandong Tang utilization at 5 years high and refinery runs recovering only gradually, the import as well as discharging activity may slow in the coming weeks ahead.
Now, remaining on the topic of sanctions and honing in specifically what we discussed at the start of this insight, when it comes to Russia-India crude flows, what is going on there?
Yep, I mean, this is quite an interesting topic, given the EU sanctions on MENA Energy. Now, everyone's closely watching for the impact of on refinery runs, crude imports, as well as product exports. Now, starting from the left-hand side chart, we see that India's crude imports are projected to fall on a month-on-month basis in August, and that's mainly due to lower arrivals into the Vadinar port. Now, on the left-hand side chart, we break down these crude arrivals into India by destination ports, Vadinar port on the red line, and the rest of the ports in bars. Now, the total crude and condensate imports at Vadinar port have actually been slowly declining since July, as MENA Energy refinery was hit by EU sanctions on the 18th of July, while the crude intake at the rest of the Indian ports have remained relatively stable. Now, on the right-hand side chart, we see that crude and condensate imports at terminals that are directly linked to MENA Energy has actually decreased in the month of August. And what's interesting is that the imports of non-Russian crude have completely ceased this month, as the mainstream vessels have avoided calling at the MENA Energy refinery terminal. Meanwhile, imports of Urals crude into the refinery have risen slightly this month, as vessels that are plying the Russia-India trade route has resumed their crude discharges after brief disruptions last month. So this overall decline in crude inflows has actually affected the refinery's processing rate, and that has led to a decline in terms of product exports coming out from the refinery. So with the EU sanctions on MENA Energy, the refinery may increase purchases of Russian crude in replacement of these missing Middle Eastern crude grades. Hence, we can actually expect the Indian refiners to continue importing Russian crude for the coming months, despite the increased pressure from US. Now, we have covered several interesting topics related to the crude market. And now let's turn our attention towards the freight market. Right just now, we have talked about the impact of EU sanctions on India's crude imports. So, Arthur, what are some of the freight dynamics relating to the Russia-Indian crude trade?
The time for me to put my freight analyst cap back on. So when it comes to the Russia-India crude supply chain, we think it could be maintained at sort of the first half of 2025 volumes. We're talking about monthly averages of about 1.6 million barrels per day. both parties at the end of the day have strong incentives to restore flows, especially after July's 20% month-on-month decline. Now, a critical bottleneck there, as amidst this increasing regulatory pressure, is really the tightened effective vessel supply, which could further shrink by 35% from the actual fleet size in the first half of 2025, according to our analysis. Now, new Iran OFAC designated vessels will likely no longer trade in Russia. We've got mounting EU sanctions enforcement. We've got non-sanctioned Western operated vessels, which also could withdraw from this trade starting September with the dynamic price cap in place. Now, as it stands, 93% of the monthly average volumes that we discussed, the 1.6 million barrels per day, could be delivered with the diminished effective vessel supply. Now, the 7% shortfall, which is approximately 105,000 barrels, would require a minimum of 7 Suezmaxes and 10 Aframaxes to join the Russia-India fleet. And you can see that vessel supply requirement on the chart on the right-hand side. Now, additional Russia trading tonnage could come from the S&P market and inactive dark fleet candidates, provided that they meet India's higher vetting standards and safety requirements, of course.
It's kind of interesting to see how the Russia-Indian crude supply chain can be managed by the current fleet of vessels and also with some small additions. We could actually potentially see the Russia-India crude trade being maintained at current levels. Another interesting topic is about the resumption of US crude imports from Venezuela. Could you share more details about the impact on vessel supply and demand?
Of course. So in late July, the US Treasury granted Chevron a restricted 6-month license to operate in Venezuela, which reversed the earlier suspension in May 2025. Hence, when you look at that chart on the right-hand side, which details the number of voyages Chevron chartered and operated lifting Venezuela petroleum products, that explains that gap there that you've got between May and July. And you can clearly see, thanks to our data, the pickup once more in the previous month. So the waiver permits production and exports from Chevron's joint ventures with PDVSA, which is effectively reopening that trade route that has been dormant for 2 months. Now, during that hiatus, we saw Aframax tonnage typically dedicated to the Caribbean US Gulf trade being redeployed elsewhere. We saw that some of these tankers found deployment in the cross-Med market, which was experiencing a period of firm rates throughout the summer. Others shifted to longer haul voyages from the Gulf of Mexico or Eastern Canada to Northwest Europe. But with Chevron's license reinstated, we've already seen 4 Aframax voyages that have loaded out of Venezuela, which is really the first signs of this renewed export activity. We've got 3 more Aframaxes that are ballasting towards Venezuela. Now, I've always liked to look at ballasters because I've always, especially the direction of these ballasters, I've always found that to be a much better indicator of freight demand than things like ton miles, for example. And what we really think here is that as this activity grows, this pull on supply is likely to tighten availability and provide broader support to regional freight levels, especially when it comes to Aframax tankers. Now, this marks the end of our MENA Energy Insights, but I'd like to take a bit of time to talk about our innovation series, which are back in 2025 for the 4th consecutive year. And we'd be delighted to host any of you watching today or your colleagues globally in the following locations. So kicking off in Singapore on 9th of September, continuing in London on the 18th of September as part of London International Shipping Week, and finishing off in Houston and New York, respectively, on the 23rd and 25th of September. Thank you for being with us for this August edition of MENA Energy Insights, and we look forward to welcoming you in the next one.